Welcome to The Explainer. Today, we are not just talking about investing. Nope, we are going to become architects, building a fortress for your financial future. We're going to break down the essential math behind a truly diversified portfolio and turn all those abstract numbers into a solid defense against whatever the market throws at you.
So here's our roadmap. First, we'll tackle why you even need a portfolio in the first place. Then we'll get into its core components, return and risk. After that, and this is the secret sauce, we'll explore how different assets actually talk to each other. And finally, we'll put it all to the test with a really practical tool for managing your potential losses.
All right, let's start with the most fundamental question of all. Why go to all this trouble? Why do all this complex, but I promise, fascinating math? It's the why that holds everything else up.
Oh, it's tempting, isn't it? To find that one rocket ship stock and just put all your money on it? But, investing in a single asset is like building your entire house on one single pillar. If that pillar fails, everything comes crashing down. That's a massive amount of risk you just don't need to take. The solution, of course, is diversification. But as we're about to see, real, effective diversification, well, that's a science.
Okay, so let's get to the building blocks of our fortress. Every single portfolio, I don't care how complicated it looks, is built from two basic things: its potential reward, which we call return, and its potential risk.
First up, the reward side. A portfolio's expected return isn't just some hopeful guess. It's a precise calculation. What you do is you take the expected return of each thing you own, you multiply it by its weight, which is just the percentage of the portfolio it takes up, and then you just add all those pieces together. Simple as that.
And on the other side of that coin, we've got variance. This is our main way of measuring risk. It tells us how much a portfolio's actual returns might bounce around that expected average we just figured out. High variance? That means a wilder, more unpredictable ride. Low variance means your returns are probably going to stay much closer to that average.
Now here's where it gets really interesting. Building a strong portfolio isn't just about picking good assets. The real strength, the mortar that binds all those bricks together, is understanding how your assets relate to each other. We measure this relationship with something called covariance. In simple terms, covariance just tells us how two assets tend to move in relation to one another. Do they rise and fall together? Or does one zig when the other one zags?
So if the covariance is positive, the assets tend to move in the same direction. Think of, say, two big tech companies. If it's negative, they tend to move in opposite directions. And this is the holy grail of diversification. It means when one part of your portfolio is having a bad day, another part is having a good one, acting like a shock absorber and smoothing out your overall returns.
Now, the only trouble with covariance is that its raw number can be kind of hard to interpret. Like, a covariance of 16 doesn't really mean much on its own. So what we do is we standardize it into a much more intuitive measure, the correlation coefficient.
And correlation gives us this beautiful, clean scale from -1 to +1. It's perfect. A correlation of +1 means two assets move in perfect lockstep. A correlation of -1 means they move in perfect opposition. And a correlation of 0, it just means their movements have no real linear relationship at all.
Okay, let's make this real. Imagine an analyst has forecasted the returns for two stocks, Bank Corp and Nubank, based on three things that could happen: good, average, or poor industry conditions. This table shows the chances of each pair of returns happening together. So for example, there's a 20% chance that Bank Corp returns 25% and Nubank returns 20% at the same time.
And here's the calculation behind the curtain. For each of those conditions, we see how far each stock's return is from its own average. We multiply those two numbers together, and then we weight that result by its probability. When you add up those final weighted numbers, you get a covariance of 16. And because it's positive, we now know for sure that these two stocks tend to move in the same direction.
So we've used all these cool concepts to build our portfolio. But how do we know if it's the right one for a specific goal? It's time to stress test our fortress. Let's grab a practical tool to see how well it really protects us when things get tough.
The safety first ratio is such an elegant tool, and it's designed for this exact purpose. It helps us pick the portfolio that gives us the best odds of staying above a minimum return we absolutely cannot drop below. We just take the portfolio's expected return, subtract our minimum required return, that's RL, and divide the whole thing by the portfolio's risk.
Let's use a real-world scenario. A client has a £1.35 million portfolio and needs to pull out £50,000 for living expenses. Now, to avoid dipping into their original money, they need a return of at least 3.7%. That becomes their absolute minimum, their RL. So the client's advisor shows them 4 different portfolio options, each with a different expected return and risk profile. We can now use our formula to calculate the safety first ratio for each one. And what we're looking for is the portfolio with the highest ratio, because that one gives us the most bang for our buck in terms of risk, specifically for staying above our minimum threshold.
And when you chart it out, the answer is crystal clear. Allocation C, with a ratio of about 0.53, it just stands out. And notice something important. It's not the one with the highest expected return, and it's not the one with the absolute lowest risk, but it is the one that offers the best chance of meeting this specific client's goal of getting at least a 3.7% return. It's the optimal choice for them.
So the key takeaway here is that building a great portfolio is about so much more than just picking winners. It's about really truly understanding the relationships between your assets and using these mathematical tools to line up your portfolio structure with your specific financial goals, which leaves us with a question for you to think about. How will you apply these concepts to strengthen your own investment fortress?